Welcome to episode 57 of Top of Mind with Consilio Wealth. Today is Friday, September 6th, 10:09 in the morning. Markets are sliding today for a couple of days in a row. We will talk about that today. I'm sure we'll mix that in. It's not on the agenda, but we can't help ourselves from talking about that. And on today's episode, we're going to talk about GLP-1 usage and the industries impacted. That's part of a follow-up from last time.
And we'll talk about the bare necessities, so the growth of expenses over time.
Look for the bare necessities, right?
Yeah.
We're just going to do that. Okay.
Please stop singing.
Okay. What?
Okay. I'm kidding. Keep singing.
I will keep singing. We're going to talk about taxing unrealized gains.
And then we're going to close it out with thematic ETFs. Are they worth investing in?
It's pretty punchy. I mean, thematic ETFs sound cool, right? Whoever designed the marketing behind that is brilliant. By the way, did you know? Fun fact, true story. The reason why they don't call them factor ETFs anymore is because the marketing people thought that factor was good, the naming, the branding, but people don't understand what factors are.
No, it's a mathematical term. Yeah,
it makes no sense. And so they changed it to like smart beta because, of course, the word smart is like, smart water and, oh, that's good. Yeah. And so factor ETFs aren't really the branding anymore. So it's kind of the same thing with thematic. I'm sure that they paid McKinsey millions of dollars to figure out what should we call these things.
To write on a whiteboard is like, this is going to hit.
Thematic. That's what we're gonna do. That's what we're gonna do. All right, where should we start?
Well, let's take a bit of a detour. We as a firm, and specifically Chris, got named Washington's Next Gen Best in State under Forbes Shook Research Best in State Washington Next Gen Advisor.
Yeah.
Out of how many advisors?
Thanks for making me blush on the podcast. Yes.
2 years in a row.
Yeah, 2 years in a row, second year in a row. Super cool. It's an award that you have to deliver financial planning. You can't just do investments in a silo or planning in a silo. You have to do full wealth management, full planning. You have to have a team. You have to be growing. You have to be attracting new clients. You have to have a clean compliance record. There's a lot of stipulations around this particular group that awards this. So we're really, really proud to have won that again, and it's just a phenomenal recognition for our little team out here that are, I think, making waves in the wealth management industry and serving our space. So yeah, it's pretty cool news.
Yeah, congrats. I wish I could say Chris was humble about it, but like he wears that Shook plaque like a necklace on our Zoom calls.
It's actually on my T-shirt under this shirt. It says Best in State, Next Gen. Yeah, that's right.
All right, we'll go for 3 years in a row, 4 years in a row.
Yeah, exactly. All right, let's go to our first item of the day, GLP-1 usage and industries impacted. We wanted to come back to this. We were talking about this last time. Because we're talking about the impact of these drugs, these revolutionary drugs, really. Yeah. And so we wanted to dive into some data on where is spending changing, and just what are preferences of people that are taking these drugs. So, Hao, take it away. You've got some good data here to share.
Yeah, GLP-1 is like the underlying technology, or I guess you call it technology, right?
Everything's technology.
It was
that's
first
all, it's
introduced.
Like thematic. Everything's technology.
Yeah, it isn't something like overnight. Like, remember the mRNA vaccine? Everyone thought, oh, we just came out of thin air. We have a vaccine. Well, no, that's been in development for decades, right? This has actually been the similar vein. GLP-1, which is like the underlying technology for like Wegovy. I can't think of
Wegovy, Mounjaro. Of course, I'm blanking on the most popular one. Yeah. Come on.
Yeah, you're screaming at your phone or your headset right now.
Oh, my God.
But
we'll keep talking. It'll come
right
to me here in 2 seconds.
GLP-1 created or introduced in 2005. So for it to hit the market in 2005, it must have been in development long before that. So this
Ozempic.
isn't Ozempic. Yes, thank you. This isn't an overnight success. This is something that's been researched for decades, and it's the outcome, right, for taking the drug has been super positive. And right now, 12% of Americans that are eligible to take it are taking it.
12% of Americans are taking it?
Yeah. Yeah, so I've read about 45% of them are diabetic needs. So the other 55% are more of, health needs. So so how it works is if you're diabetic, your doctor can write you a prescription and you're getting that treatment. If you're simply wanting to lose weight, which I think is a, commendable thing, you're paying most likely $1,000 a month. And that's where I'm getting that.
Yeah, they're really
from.
expensive.
Yeah. So Chris's question was, McDonald's is quaking in their boots because people are spending less. And I was like, well, the market that's eating less McDonald's, do they have $1,000 to spend, right? Like that's 12% of adults is a ton of people. How many of those people were regular McDonald's users or eaters or, customers? And how many are willingly shopping there, right? Or
we wanted to reveal, because you brought up that, sure, it's out of pocket, let's say $1,000 a month, but that in a lot of cases the drug is paid for by insurance. Therefore, there is no out of pocket cost outside of, maybe a deductible or something.
Yeah. So we don't have data on McDonald's, and again, they've been pretty coy about bringing this up. Which, if there's more adoption, right? Because the demand is nearly 3 to 1 right now. There's tons of people who want access to this thing. One, it might be unaffordable. $1,000 a month is quite a big expense, right?
Yeah, it's a lot.
2, just not enough supply of it yet. There is one of the big companies, I can't remember. And again, none of this is investment advice, but one is offering a $500 a month dosage where it should have the same impact, right? So by losing the weight, you're lowering cholesterol, you're improving heart health, you're improving just general body health. But one of the big reasons is your need or your cravings essentially go away. And we have data from people who are users of the GLP-1 drugs, about 2,000 respondents here, so it's not the entire pool, right, of Americans, but most in this particular survey have said they're spending more on groceries, and they're reducing their takeout and delivery and dining at restaurants. I don't know why they're two different categories. I guess takeout, is takeout, right? You're taking it home or eating in the car. Dining at restaurants, going way down. So spending less. So spending less in the groceries, the respondents said 31% figure they're going to spend less in groceries because, you're craving less, you're going to eat less, right? I think that makes sense. Spending about the same, 46%. And then 23% in this category, grocery shopping, is spending more. That's the biggest increase in spending more out of the three. Taking out delivery.
Hold on, I'm confused. I want to come back to this here. So what I'm seeing here is that takeout and delivery and dining at restaurants pretty much are in alignment with spending less. So both of those categories are spending less.
Yeah, about 60% of the respondents plan to spend less in takeout and dining. 61 and 63 respectively. And then
those are in alignment and basically across the board. Spending about the same is roughly in alignment, and spending more is roughly in alignment. Yeah. Only about 8-9% spending more. But then the biggest shift is the grocery shopping, which is 23% spend more, 46 about the same, 31 spending less. So this would tell me that people are eating at home more and cooking.
Yeah,
their own,
which generally is healthier unless they're buying, Captain Crunch or Cinnamon Toast Crunch. But
fair.
I think that is a trend that shows yes. Food at home is going to be, 1, cheaper, but 2, most likely healthier.
Definitely.
And under the same report, Morgan Stanley stuck their neck out and said, hey, these are the companies that are going to do well, and these are the companies that are going to face pressure, right? So the companies that are expected to do well, again, this was an article back in April 2024, so it's 5 months old, so we've had some time to let this stew a little bit. The companies that are expected to do well were Kava, Chipotle, Sweet Green, and Starbucks.
Not
The
a
last one
recommendation.
surprises me.
We're just
Yeah.
quoting Morgan Stanley's article here.
And then the companies expected to do poorly are Jack in the Box, Wendy's, Wingstop, Shake Shack, and Portillo's, which in California I've never heard or seen.
Yeah, I think it's a Midwest thing.
And in terms of other types of products, Hershey's is expected to do poorly. In alcohol companies like Diageo, which I mentioned last time, and Molson Coors or Boston Beer, because GLP-1 reduces cravings for alcohol. And healthier food brands are Vital Farms, Bell Ring Brands, and Simply Good Farms are expected to do well. So
Vital Farms, the maker of my overpriced eggs that I was complaining about
going back to that,
6 months ago.
I don't have their price targets here, or the price performance, Chris. So if you want to go to the chart, I'm going to pull up Vital Farms and the other healthy.
Let's go there in a minute. I just want to say, I mean, couldn't happen to a nicer group of people, right? Like these companies are just, I mean, get them out of here, right? Like McDonald's is complaining that people won't buy their crappy food anymore. Good, thank you. Fix that. I mean,
I thought you were talking about Bell Ring Brands for gouging eggs.
No, fine. I mean, that's whatever. But I mean, it's just, I don't know. The fast food industry is so terrible. It's so terrible. And I mean, this to me is just like so awesome that there's this drug that basically just puts the middle finger to these companies so that they have to figure out how to make their products less addictive. And, maybe start serving real food instead of, isn't a McDonald's burger like 23% beef? This is insane. This is not food. This is not a podcast about food. But I think this is great. And Hershey, by the way, Hershey. So when we do, so I'll talk about a thing, I guess, for a minute. But when we do a thing called direct indexing for clients, direct indexing is where you're buying the individual components of an index, say the S&P 500, directly in your account versus buying the ETF. Well, you do that for some tax efficiency and some sort of advanced tax loss harvesting. But also, you could have the ability to, if you wanted to, screen stocks. You could do your own like ESG, socially responsible screen on those stocks. If you go into the screening tool and you screen out childhood labor, guess what one of the companies is that gets kicked out? Hershey.
Really?
Terrible company. And their negotiations with their raw product, their cacao product and stuff, they're horrible. The whole chocolate industry is pretty challenging. I think there's that's where the whole fair trade, but there's even another standard, like you'll see it on chocolate bars that are kind of designed to say like, yeah, this wasn't made under
fair trade.
Yeah, it's fair trade, but there's another thing too. There's another stamp you'll see on chocolate bars, and it's supposed to be less, childhood labor and horrible. Anyway.
Not to make light of child labor, but like it reminds me of like Willy Wonka and that the fat German kid who drinks the chocolate out of the river and falls in. Mm-hmm. Like I'm sure Hershey's runs into those workplace incidents all the time.
Mm-hmm. Yeah, it's an actual promotion video of Hershey. Actually, is what that is.
Of a German kid falling in.
Yeah, that's exactly what Hershey teaches their people for their.
Okay.
Anyway, okay, moving on. Back to the chart that you wanted to talk about.
Thanks for stalling, yeah.
I just really wanted to give some context to my real feelings about these fast food companies, so.
Okay.
Now
you might have heard my dog barking. I was muted, so Chris is stalling extra.
The dog was trying to comment too, so.
Yeah.
Appreciate that.
So, performance. I just went back 3 years because GLP, had been out in the marketplace for quite a few years, but more so in the last year or so. Out of the companies that are expected to do poorly, Jack in the Box has done poorly. Portillo's has done poorly. Wendy's has done poorly as well. They're all negative. Jack in the Box is negative 50% over the last 3 years.
Oh, gosh.
And then Shake Shack is up 29% over the last 3 years, but again, relative to the S&P, very poor performance. Wingstop up over 124-25%. So
Do you like wings?
I do, yeah.
Wings don't
I
do it
don't
for
know
me.
if I'd pay wing prices in today's dollars, but yes, I do.
Wingstop
But
does it for
Wingstop
me.
has done well because, well, at least that's the CEO saying live sports. But overall, Morgan Stanley has hit pretty correctly these other names that have, that are expected to do poorly under GLP-1.
You remember when the Jack in the Box salmonella thing came out a bunch of years ago?
Yes.
I wonder how many people are like me. And so that came out like when I was a kid. And I remember my dad being like, don't ever eat there. And we never ate there. And I don't think I've ever eaten there to this day because of this like salmonella scare that was, I don't know, 25 years ago.
Yeah. One of my friends' dads always said, don't eat at a fast food place where a teenager's handing you food.
Well, that's
Okay,
impossible.
Well, yeah. So don't eat fast food. Is basically
Okay, that's
his
fair.
point.
Yeah.
And he was a mortician, by the way, so he definitely dealt with that. So the next group was expected to do well. I think bit mixed results here. Kava Group and Sweet Green have done really well. And again, Kava Group does hummus dips and healthy dips. And
You might be wondering who this was. We had to look this up. So Kava Group, what is that? Well, they actually have some restaurants around, but
okay.
you will see their like dips and dressings in the store. And it dawned on me, oh yeah, I've bought their hummus before. It's like Kava hummus. So if you Google Kava, Cava, you'll probably see their logo and you might recognize it. At least that's how my brain works, is logos over the words. Just how my memory works.
Over the last 3 years, Kava and Sweet Green done really well, up over 160%. Chipotle not so much, and Starbucks is negative 7%. Chipotle's up 30% over the last 3 years. So you might be hearing these positive numbers, but in my mind, it's just relative to the S&P. And the S&P.
Starbucks has a lot of sugary drinks. I'd be curious to dive into. Starbucks will probably never reveal this data, but what customers are preferring. Our customers not buying as many caramel macchiatos or frappuccinos, and they're trading down to an Americano, because of less sugar. I mean, some of their drinks are insanely high sugar content and calorie content. And
that's how they keep coming back, right?
That couldn't happen to a nicer bunch of people, like I said.
Yeah, let me correct myself slightly. I say you do poor if you're up 30% over the last 3 years. Guess what the S&P was doing over the last 3 years? 30%.
Last 30?
Yeah. I thought the S&P was on fire, but
I was going to say a lot more than that. But I have to remember that it took 2 years to get back to where it was.
Yep.
And that just crossed in January. It's like January 15th that it crossed the November 2020 high.
Yeah.
Wow.
All right. So Chris's favorite category?
November 2021. November 2021 high.
Yeah.
That's what it was.
So Chris's favorite category was the healthy food produce. So is it Vital Farms is the egg price gougers, right?
Yeah, it looks like I should have bought some stock.
And Bell Ring Brands, I don't know what they make.
I don't know.
I'm guessing healthier foods, and then Simply Good Foods. So Vital Farms up over 107% over the last 3 years. Bell Ring Brands up over 134%. Simply Good Foods, pretty flat, actually negative 15% over the last 3 years. And then the companies that are expected to do poorly in the food categories as well, pretty much across the board, only Molson Coors has been keeping up with the S&P, up 32%. Everyone else has been lagging. But specifically point out Diageo, which I think makes like Captain Morgan and other gin products, down 29%. So people are drinking less, and this is not like a short-term trend, right? All these numbers I'm throwing out are 3 years.
Okay, Bell Ring Brands makes ready-to-drink protein shakes and other RTD beverages, powders, nutrition bars, and other products primarily under the Premier
Makes
Protein.
sense, right? If you don't have much cravings, you're going to, at least get some nutrition through drinks.
Mm-hmm. Yep. And the other one there was Simply Good Foods. Is this like the Simply brand? Use Atkins Investment. These are all pretty small companies. Billion in
Yeah.
revenue.
Yeah, so
Okay,
those
Simply-
percentage gains aren't like adding hundreds of billions of dollars. Still, it's very small.
It's the same category. Protein bars, ready to drink shakes, sweet and salty snacks, cookies, protein chips, and recipes under the Atkins and Quest brand names. So they bought Atkins.
So basically, the flavorless food has done pretty well. The flavorless healthy food has done pretty well under this.
Well, this is still processed food, right?
Yeah.
But it's
Yep.
it's a little bit more of reviewing ingredients,
Yeah.
and sugars and things like that.
But I think the big thing is you're not craving bad foods.
Oh, that one hasn't done well. Sorry, back up. The Simply brand has not done well compared to
Yeah.
Bell Ring and Vital Farms,
Yeah.
the overpriced egg company that I buy from.
Chris alone has kept that egg company.
It's like they say, if you instead of rather than buying each iPhone, if you just bought Apple stock instead, you would have had, I don't know, a couple $1,000,000 or something like that. And so
Yeah.
rather than buying Vital Farms eggs, I should have just invested the $13 each time, and I would have doubled my money. Look at that.
All right.
Not investment advice.
So GLP, again, keep an eye out on trends. McDonald's has been abstaining from addressing GLP-1 usage, but we would think, and Chris would hope, that McDonald's continues to lose market share. All right, bare necessities, right?
Look for the... Wait, we got to talk about... did you talk about the food categories?
So Morgan
Go
Stanley
through this. I think this is interesting.
Yeah, Morgan Stanley also put out a long-term forecast by 2035. They broke out food categories like ice cream, cakes, cookies, candy, and yada yada. They estimate what would be the biggest losers. So ice cream is expected to have a 5% drop in consumption over, let's say, call it the next 10 years. Cake and pastries down 5%, cookies down 5%, candy down 4.6, chocolate 4.6. So you could see just the junk food is being, reduced in terms of consumption, or the expected consumption of junk food.
Largest one on here is ice cream. So it's like the number one most reported craving that goes away on for people that are taking GLP-1 drugs. And I was looking this up. So Ben & Jerry's, so Unilever owns Ben & Jerry's, and they're selling it, or they want to sell it. And so they bought it 24 years ago for a ton of money. And I was just trying to get the data here real quick. But anyway, the point is they are looking to sell. Okay, so they bought it in 2000. They bought Ben & Jerry's for $326 million. And I think they're trying to sell it for a fraction of that. It doesn't really say. Anyway, point is, is this them trying to get out ahead of this potential trend? Like, are they being strategic, saying, let's get rid of this business before it's worth far less? Or are they just saying, ice cream's challenging because it's a freezer truck, not a refrigerated truck. It's expensive. I bet it's an expensive business, right? Mm-hmm. But anyway, I just think it's kind of interesting. But yeah, and all of the ice cream brands that Unilever owns, they are focusing on spinning, which is interesting.
Yeah. So again, whether ice cream has a future or is big as it is, I doubt it if this trend keeps up.
Yeah. Okay. Moving on to bare necessities.
Bare necessities.
Yep, go for it.
Yeah, the chart, we have data going back to 2000, and it's just Goldman tracking the increases, right, for wages or median household income, homes, the price of homes, education, and food. And you want to guess what's in fourth place out of the four categories?
Income.
Yeah, income up 78% since 2000. That's median, so that's average income. That's pretty
Median, so it's
worrying.
middle. Yeah.
Yeah, and then the
I
cost.
wonder
of
how that
everything.
compares to the average, interestingly, but the median
Yeah.
is probably far better to look at because I bet the average is far higher, just given like rise in CEO pay over the last 25 years and whatnot.
Yeah, the leader of the pack is 169% since 2000 is education.
That's so insane. And I wouldn't have guessed that, by the way. I would have if you asked me, here's the four categories, what's the highest? I would have said homes.
Yeah, Holmes is in. I clicked away.
147%.
Holmes is second place.
That's
Yeah,
second.
147. That's only because of COVID too. So Holmes would have been in the low 100s.
I mean, so that's a good point. Homes would be far more reasonable without COVID. The other observation I have here is this line of education. It's almost perfectly up with zero volatility,
Yeah,
and which says that every single year,
universities
cost of
are raising
college
tuition. Yeah,
goes up without fail. And we tell clients this all the time. The 10, 20, and 30-year growth rates for education is 5%. 5% compound. It's crazy. And it's every single year. It doesn't come back down.
Yeah.
Versus home prices have swung around a lot in the last 25 years. 08, 09 brought prices down. COVID pushed prices up. Even food. Food is a smoother line, really kind of until the last couple of years. But nothing is more smooth than
98%.
education.
Yeah. A straight line up and to the right? And incomes are not keeping up with that.
100% in 24 years, though, is not too bad, right? That's just Rule 72.
Yeah.
So that's not, that's like 3%.
Yeah, and I think just looking at the chart, it's like costs for everything are going up other than wages, right? So I get why people are angry, but again, I think we've argued that prices need to go up for wages to go up, right? That's how businesses can pay higher wages. Mm-hmm. It's not the other way around. Like, we have to understand that higher wages are more of a byproduct of higher prices.
So for everybody so I just said Rule 72. So quick explanation on what that is. So,
I assumed everyone knew.
No, it's all good. So you take an interest rate and you divide it by 72, and it tells you how many years it takes to double your money. So 7.2%. If you make 7.2% on something, 7.2 divided into 72 is 10. So it's 10 years to double. So that's how I did that math, saying, well, 100% over 25 years, if you divide 72 by 3, that's 24, roughly. And so that's where you get this 100% return, which looks scary on paper, but really it's just a consistent 3%, 3%, 3%, 3%. Now, we know from prior conversations that it was more like 2, and then it went up by 9, and it's it's jumped the trend line. But I just want to make that point on how to figure out returns like that.
Yeah, prices do tend to move up, right?
Yeah, and that's healthy.
Yeah, thanks, inflation.
Yeah.
All right, so next category I think is yours, right? Kamala Harris's proposals.
Yeah, so unrealized gains. So taxing of unrealized gains. So this was a proposal that Kamala Harris had come out with, and it looks like it's mostly for individuals exceeding 100 million of net worth. So we wanted to talk about this because we had some clients bring this up to us a couple of times in the last few weeks, and I think our general response is that most of these types of proposals are really just proposals. They take a lot of negotiation, a lot of work to actually get anything sort of through, and whatever proposal gets approved, if anything, will very likely look vastly different than what was what was actually proposed. But so to give context on what it is, so Kamala Harris endorsed the tax increases which were proposed by Joe Biden, which was a 25% minimum tax on total income, including unrealized gains for individuals exceeding $100 million. Interesting. But so if enacted, taxpayers with wealth above $100 million threshold would have to report unrealized gains for each asset annually, including the basis or the original purchase price, which is the same thing as basis.
Yeah.
And they'd have to report, and pay tax on that. I think this is pretty unlikely to go through. But what's your read on this, Hal? Like, what do you think about the proposal, and what do you think about the likelihood of it actually going through in a material way?
I think it's playing politics. It is, again, something that Republicans can definitely hone in on, saying broadly she wants to tax unrealized gains, but it's $100 million net worth or more, right? So that's a very small portion of the population. Again, the idea could be like the slippery slope of dropping that standard down, let's say to 50 million, and then
Right.
I doubt they're going to do that for 50,000, but you know what I mean? Like,
Right.
I think that's what people with lower net worth are concerned about, is that bar gradually goes down, which it does if you're just looking at the history of government. The other side is it does take an act of Congress to enact tax changes. So the odds of this passing are low. Yeah, if anything, it just creates more talking points for both sides. And we know that doesn't really go anywhere.
There's another piece of this too. So there was a proposal here for 28% long-term capital gains for households making more than $1 million annually. I think that has more likelihood of going through.
Yeah.
And that would also, I'm sure, include the net investment income tax that triggers above $250,000 of income currently for married filing jointly, which would be another 3.8% on top of there. That's probably more of a likely change than taxing folks above 100 million.
Yeah.
But we'll see.
And we're not picking on Kamala Harris. It's just Trump did speak to the New York Economic Club. There was nothing substantial to really pin. He's like, there was nothing proposed specifically about taxes, about how to pay down the debt, nothing. So we weren't picking on Kamala. It's just she had more specifics to point out.
Yeah.
And to
right.
address.
Well, she's made it a part of her campaign.
Yeah.
Trump has not. So Trump is focused more on, I delivered tax cuts and look at how great that was, versus I will deliver more of those, right? So it's just a different, kind of different proposal in his mind. The other thing that's worth noting here is that the Tax Cuts and Jobs Act, which was enacted by Trump when he was president, that will expire at the end of 2025. So the top tax bracket is currently 37%. That will go back to 39.6, and tax rates in general will kind of adjust, or the brackets will kind of adjust upward a little bit. That should also expire the SALT cap, though, that $10,000 cap that really affects people in California and New York a lot, but affects a lot of people that have a lot of itemized deductions, and they get capped out on their income tax, like state income tax, and sales tax and
mortgage interest,
property tax,
yeah.
Mortgage and
property tax.
Yeah, it's taxes that you get capped on, not mortgage interest. But anyway, so without doing anything, taxes will go up in 2026. At the end of 2025, remains to be seen if that proposal gets extended or changed, which could be an outcome of the election, and we'll see. We'll see what 2025 brings, because this will be a hot button item in 2025.
Yep. So yeah, as information comes out up until November, it can't come soon enough. Just let this election be over with.
It's almost here.
We'll try to at least address some of the concerns that we do here. It's just, at this point, nothing but politics.
Yeah. All right, let's move to thematic ETFs. What are thematic ETFs, first and foremost? And then we'll dive into what we're seeing here.
Yeah, the thematic ETFs, I think we can thank McKinsey for the name. I'll just give them credit for it. It is a ETF that hones in on a theme, right? So the theme of the day is AI, or the theme of yesteryear was solar power and battery power, electric cars, right? So there's always this theme that is the hot button issue of the stock market, right? And yes, companies have definitely already benefited from it, right? I'm looking at you, Magnificent Seven, where every earnings call was, how can we feed AI or the term AI into our earnings? And there we have it. We have investor interest at an all-time high for a certain category, and then fund companies pounce on it and release or feed that need, right, by releasing a thematic ETF. So you'll see ETFs that are hyper concentrated in one category or one industry, sometimes one stock, right? They'll just lever up that stock. There's an NVIDIA 3x upside in a NVIDIA 3x downside ETF. And we do have quite a bit of recent history that investors, surprise, don't make much money off these things.
There is a Jim Cramer ETF, and there is a short Jim Cramer ETF. And everything that he says to buy or sell, it either goes along with that or it goes in the inverse of that. So you can actually trade a commentator.
Yeah, I think the most famous one is ARK under Cathie Wood. There's, to Chris's point, there's also SARK, which goes exactly the opposite of that. Again, all this is just a, from my cynic's point of view, a ploy to capture as much expenses from investors as possible.
Are thematic ETFs dangerous in your mind for investors?
For the retail investor, I think so. So when you look at a theme, you're assuming quite a few things, and you probably don't even realize it, right? So if you're investing in semiconductor thematic ETF, right? One, you're assuming that the entire technology sector is going to beat all other S&P sectors, right? So the S&P has 11 sectors. Try picking the winner year in, year out of that 11, right? And then go to the technology, assuming technology is the winner that year. Then you're going to pick semiconductors, right, in our scenario, over SaaS, over cloud computing, over software, over PC, smartphone manufacturers. So you're saying semiconductors will beat, of the technology beating 11 other sectors, going to beat countless other industries within the subsector.
I see what you're saying.
That's what you're jumping into by making that purchase, because you're assuming that you're picking the best sector and the best industry and then the best subsector of the industry, right?
And then further, you're exposing yourself to
concentration,
more concentration, right?
Higher fees.
Right. Yeah, a lot of these ETFs, it's worth noting, they are very small in size. So I think a common misconception amongst investors is, I'm buying an ETF, therefore I am smart, I am passive, and I'm getting low cost. And that is true if you're buying an index ETF, an ETF that is designed to replicate an index. Generally, those funds are huge, and the size of them allows them to make the cost very low. Think, the Vanguard S&P 500 fund or the iShares. Those are 0.03% to buy those things, right? It's nothing. It's free. Some of these other thematic ETFs and other kind of more concentrated ETFs, you could pay upwards of 1% for those. And so you're thinking that you're getting ETF pricing, and you're being smart and cost aware, cost effective, but some of them are even more expensive than their mutual fund counterparts. So take note of that. Lots more concentration, potentially more fees, and carrying along a theme, doubling down on that theme.
Yeah. So Morningstar did research like a 5-year stretch from 2018 to 2023. The average return for thematic funds, and again, this was a pretty strong bull market stretch here. The thematic return on average was 7.3% per year, but the average investor saw just 2.4% average annualized return during that same period using those same funds. So what that implies is the retail investors were jumping in and out the wrong times.
Common, right? And again, failure number 2, right? Failure number 1 is there are hidden costs here and a lot of concentration. So definitely know what you own we talk about that a lot and how you've written about that. But then failure number 2 is you think you're being passive, but then you're actively trading your passive funds. That's not right either, right? And so, how does, and this is, by the way, true in the S&P. You can look at the S&P data. What does the S&P earn? And then what does the average investor in the S&P index fund earn? And it's far less. It's crazy. It's crazy. People trade a lot. I would add one thing to this commentary too. These thematic funds are really centered around momentum. So it's the hot topic of the day, and it's a momentum trade. And momentum trading is a technique that is, well, it's following the momentum, right? If a stock is going up, your belief is that that will continue doing so, and you want to sort of ride the wave. It doesn't matter if the stock's overvalued or whatever. Nothing fundamental about it. It's the momentum of the stock. So thematic, by definition, it is riding a theme that is hot right now. And that's also why a lot of these funds have underperformed, because they tend to get created by fund companies to, raise capital and make money after the theme has really been born. And so, if you bought NVIDIA at $6 and, you still own it today, split adjusted at, 105 or whatever it is to right now, you've done pretty well. But now that NVIDIA is in all these thematic ETFs and you've actually lost money because NVIDIA is like 30% off its high, and you're wondering what's going on, that's why. The thematic ETF was created after the theme as kind of an asset grab by these big companies. So in sum, know what you own, know why you own it. And if you do buy one of these in your account, just be very clear on how much you're owning and what are the contents of that fund, because it'll expose you to a lot more concentration risk than you might be aware of.
Yeah, so again, stay broadly invested and diversified. That's probably the only way you're going to capture some of this. But most importantly, you're going to prevent some of the biggest blowups.
Yeah, totally. Okay. Well, I think that's all the time we have today. We covered what we needed to cover. So awesome. Everyone, thanks for tuning in today. As always, we will catch you again in 2 weeks. And signing off for now. Take care.
All right. Thanks, everyone.